Good afternoon, everyone, and thank you for joining us today. My name is Greg Burris, and I'm the Director of Investment Portfolio Oversight and Reporting at Foundation for the Carolinas. And on behalf of the executive leadership team here, we certainly thank you for joining us today. As always, if at any time during the webinar you have a question or would like further clarification on a specific topic, please post your question in the chat window and we will work to get to that towards the end of the session. I will now turn it over to Travis Pruitt and Tim Westrich, who will lead our discussion today and give you an update on current market conditions and second quarter results. Travis?
Great, thanks, Greg. Hi, everybody. Welcome back. Thanks for joining us today. As Craig said, we'll give you a sense of where we ended the quarter. It's certainly been no shortage of interesting things to talk about. And we've got a little bit of a relief rally here in July, and so we'll just give you a sense of where we stand as of then. So hopefully everyone can see my slide. We'll start with a second quarter performance recap. Perhaps not a mystery or a secret to anyone at this point. Rising rates throughout the course of the year have really driven concerns about slowing growth and really this notion of trying to react to inflation. So as a result, virtually all asset classes this year, and certainly in the second quarter, were negatively impacted. And so you can see most of these bars are pointing substantially to the left. That's led really equity stocks or global equities as defined by the All Country World Index here, down just about 16% in the quarter. One of the more challenging periods in a while. And pretty widely shared across asset classes. U.S. stocks is measured by the Russell 3000, so this is basically the entire U.S. stock market, down a little bit worse than the globe at about 16.5%. And we'll go through some of the style impacts here in a minute. And EFA stocks, which are developed markets outside the U.S., down just a little bit better, if that's a term here that we can use, outperforming the U.S. by about 2 full percentage points over the course of the quarter. So U.S. stocks had performed better in the first quarter. Non-U.S. stocks had really sold off worse, but we did see in developed markets a little bit of trading places for the second quarter. In terms of relative lights in the tunnel, emerging markets did hold up a bit better in the quarter than their developed market peers, at down about 11.5%. A big portion of this was supported by a rebound in China. So as you may be aware, China itself has been basically closed for much of this year due to their zero COVID policy. And as a result, investors had sold that and a few other things had gone over the last year. Investors had sold China shares. As China began to reopen in the second quarter, we did see stock markets rebound. And so while it doesn't feel like much, up 1.6 when the rest of the world is down double digits is quite a tremendous outperformance. That had some positive impacts on some of our portfolios and certainly had a positive impact on emerging markets. All of this brouhaha really comes from a couple of places. Certainly the geopolitical actions going on in the Ukraine are contributing to all of these things, but the drive in inflation over the last year, or the increase in inflation over the last year, and the corresponding increase in interest rates has really been the primary symptom of most of these movements. And so we've seen interest rates fall pretty significantly. In the Bloomberg Aggregate Bond Index, which is our core fixed income benchmark for the portfolios, down nearly 5% for the quarter alone. Those are almost unprecedented. It's been 40 years since we've seen bond returns to this magnitude to the downside. And it's in part in response to, depending on when you want to choose to measure it from, up to 15 years of quantitative easing, both in the US and globally. So the Fed and other central banks now are beginning at least to reel in. And that's caused a really significant move in rates. And as you are probably aware, as rates move higher, total returns move lower. And so that was a meaningful impact. And you can see in some of these other longer maturity strategies, very equity-like returns in the quarter as interest rates rose. We even saw for the first time, mostly in June, that commodities and commodity-related stocks actually sold off as well. We saw the price of oil come down as concerns about economic growth started to peek through. That started to impact even places in the marketplace that had held up pretty well up to that point. When we think about the year to date, the quarter just extended what had started as pretty difficult returns for the first part of the year. And so you can see that US and non-US stocks, again, collectively, the modestly better performance out of emerging markets and EFA, particularly in the China area, you can see here after that rebound late in the quarter, outperformed US stocks for the first 6 months of the year. And but those are still pretty meaningful drawdowns. Our basic thesis currently is that much of this drawdown is driven by valuation resets. So as rates change, the valuations that investors are willing to pay for stocks change. And as those rates go up, typically those values go down. And so we do think that much of this is as a result of resetting valuations. And that suggests potentially, and we'll talk a little bit more about this later, that suggests potentially that if we see some slippage in earnings in the second half of the year, we could see some additional volatility potentially to the downside. We're not making a very strong call on that, but in terms of just evaluating and considering what risks could be on the horizon, we think that that's an important one to consider. Just finishing up on this page, you can see, as I talked about, aggregate bonds down about 10%. That's a very, very non-traditional move in fixed income. And with the change in environment, it has really been a very long time since we've seen any kind of movement like this in fixed and across those asset classes. So why don't we talk a little bit about just how style performance has changed, because for an extended number of years, the growth style did outperform value, not just in the US, but globally. But we're gonna review US amounts so far this year. You can see that the Russell 1000 value, which are generally speaking lower valued stocks, sectors that typically have been in this style have been things like energy and financials, a little bit of healthcare. Those sectors have held up remarkably better so far this year, in addition to the stocks that had lower valuations in general. And as interest rates changed, we did see the value part of the universe start to pick up versus growth. A couple of 2-3 years ago, this was very much in the other direction, where growth in a very low interest rate environment with strong growth potentials on the horizon, the growth half of the marketplace really outperformed. And we see the style leadership rotate over time, and at times it can have pretty dramatic differences, as we see here in the two larger cap indices. We saw the same thing in the small cap indices, just about the same magnitude, maybe a little bit less on a year-to-date basis, but the 2000 value index, again, cheaper quote unquote stocks amidst the small cap universe outperforming their more growthy brethren. You can see as well that small caps underperformed in the second quarter as investors really did start to discount in the possibility of lower growth and lower domestic growth, where small cap stocks will be most typically leveraged. Just finally on this page, as you may recall, we do have some lower volatility, higher quality exposure in the portfolios, and that has really added value both in the quarter as well as on a year-to-date basis relative to the broader equity markets, as investors did reposition into more stable stocks or companies that are anticipated to have more stable experiences in what would be in what could be an economic drawdown. So that was helpful for our portfolios for the quarter. We talked about this a little bit, but inflation really has been driving this. And these, we're at the highest inflation rates that we've seen in 40 years. I'm in my 30th year of financial services, and the last time we had real meaningful inflation, I think I was in middle school. So this is a new experience for most people in the industry, and it's not always been fun, frankly. But we are seeing high inflation and those big inflation prints. We do see a little bit of potential rollover on inflation. We've seen the price of oil come down pretty significantly in the last couple of months. Energy has a way of infiltrating throughout pricing in general. So our expectation is we should see some moderation in inflation as we head into the fall. But the surprises have definitely been to the upside. So we think that that potentially could be a risk. The market, however, has taken a different view, at least, or is beginning to price in this notion of changing, if not going back to where we were, getting back to something more historical. And so these are two measures of how the market is pricing in expectation for inflation. On the left side here, the 5-year inflation break-evens. This is basically the spread between a nominal 10-year Treasury and these are 5-year inflation break-even. So there'd be a nominal 5-year in Treasury versus a 5-year TIPS. And you can see that after peaking at north of 3.5% with the expectation for inflation over the next 5 years, that's really moderated back down to something closer to 2.5%. And while it's not the 2% target that the Fed targets, it is definitely demonstrating that market participants believe that, at least depending on your definition of transitory, that inflation will come back down. And you can see that this on the right-hand side, it's just a different take, but it's expectations for 5-year inflation 5 years from now, and that has come down closer to 2% from being north of 2.5%. So the market has priced in, and these are actually through the end of July. So the market, even since the end of the quarter, has priced in moderation of inflation into market rates. Sorry, I drew pictures on that. Move. This next chart is another way to look at that, or to see, really capture how the market is pricing these things in currently. And on the left-hand side of the chart, again, I threw in an updated page here as we had it available, so I wanted to use it so you could have a good sense. This is basically the market's implied pricing for changes in short-term rates over the next couple of years. And the purple line is where the market priced short-term rates, or the expectation for short-term rates at the end of 2021. The green line is where we were at the end of 2022, and the blue line is where we are at the end of, at the end of June, and the blue line is where we are at the end of July. And basically what this kink means is that the market is pricing in overnight rates to achieve about a 3.5% rate by the end of this year. And then with this downward sloping activity, the market is pricing in likelihood of Fed cuts in early 2023. That feels, in my personal opinion, it feels like the market may be a bit of ahead of itself, but there is some guidance from the Fed on this notion, as well as some of those other inflation figures. So the Fed has been active. They did just change their stance at the margin in terms of being data dependent, but they have been quite demonstrative and deliberate in their messaging to the marketplace from the notion of where they believe their rate policy will go. But you can see it here is that the market does expect more rate hikes through the end of the year, and then some moderation in that. Right now, the Fed does indicate that their definition of neutral rate is right about 2.5%. Neutral meaning that the rate of interest having not a positive or negative impact on economic growth. And you can see that the market is pricing in, perhaps a bit of a discount to that as we move out the couple of years. You can see that that change, this change in view and shift has also impacted 10-year yields. We did see 10-year yields on nominal bonds move north of 3.5% late in the quarter, but those have reversed quite significantly here in the short term. Again, I think it just feels like that's a bit ahead of itself from a market perspective, and so we could see continuations in this kind of volatility through the end of the year. I should note, I meant to note this on an earlier page, but as these yields have come down, we've seen equity market returns improve as well. So July was, July was positive in equity market returns pretty much across the board. We did see leadership shift back into the more growthy parts of the marketplace. So as real yields came down, as you can see here in the green chart, as real yields have come down, investors have been more willing to take growth, longer term growth risk. And so we did see the growth part of the marketplace outperform in July. And again, I think it remains to be seen how that volatility plays out. As we see earnings reports through the rest of the year, I think that will be important. So, excuse me, what does this mean to the portfolios? Well, on a relative basis, I think overall we did okay for the quarter. It's hard to feel okay when you're down double digits, but we did see premiums from both our U.S. equity building block as well as our non-U.S. equity building block, and both of those portfolios also outperforming their particular indexes over the last year. So we want to try and generate as much outperformance as we can, regardless of the environment, and we are fortunate in this time to do so. We did get a nice little premium out of our global opportunities allocation for the quarter, predominantly on a very strong June, as we got some rebounds in some of those specific exposures. As a reminder, global opportunities is a component of the diversified long-term growth portfolio. We do expect or target for it to outperform global stocks over a full market cycle, and it will have some more volatility and tracking error associated with that, as we have certainly experienced, unfortunately, to the downside of the last year. But we retain a lot of confidence in that strategy and the underlying managers, and feel like it's going to be, over time, it will be additive to your portfolios. The real return assets held up reasonably well. I did mention in my preamble that natural resource stocks, which had by and large avoided the carnage in the first part of this year, did catch up to some extent in the second quarter, as the price of oil came down and expectations for economic growth did moderate some. The fear of recession started to grow, and so we did see that translate into stock market returns in the second quarter. You can see on a year-to-date basis that we've got nice value out of our listed infrastructure. Nice to have a positive there, as well as that seems off, but and the natural resources index also holding up really pretty well. From our risk-reducing assets, we've talked about this a couple of times. Our hedge fund strategies really demonstrating their value. Again, the hedge fund investors allocation is in the diversified long-term growth portfolio. We own it in lieu of additional traditional fixed income allocation. And from that perspective, it's nice to see it outperforming the fund-to-funds index itself. But perhaps most importantly for long-term portfolio design, it is producing meaningful premiums versus our core fixed income strategy, which it would otherwise replace within that DLTG portfolio. So we're very happy with the way that that's performing. We're getting a nice premium, and we're getting that diversification benefit from between both stocks and bonds. We did have a little bit of a struggle in the quarter and on the one-year period with our active fixed income portfolio. As you may recall, we do have a bias to credit and corporates there, as well as, if you will, some plus categories. So some lower rated debt, a little bit of non-US debt. We generally like those allocations over time, and we like the managers to be opportunistic within them. But in a period like this, where there has been some concern of global recession and pullback, we did see those positions underperform, and that's translated in performance here. Nothing we're concerned about in the short term, but we could see some additional pressure if we do see the economy step back over the course of the quarter. I did look at July numbers. It looks like in addition to rates falling, it does look like spreads narrowed as well, and we got a little bit of outperformance in July from this portfolio. So happy to see that. We have been underweight duration. So in our long-term portfolios, we own not only this core fixed income position, but also an allocation to sterling, which is the manager in the low duration standard pool. Having that lower duration relative to this aggregate benchmark has been positive. We've been that position that way for some time, with the expectation that rates would eventually rise, and as they have, that's helped us collectively outperform our bogey here in this portfolio, even while those returns are down. And then I'll point out, as we move up that kink, if you will, in the curve I showed you earlier, that's translated into increasing return within cash, which is something we have not seen in a while. So I think the building blocks, by and large, within expectations, and no real concerns on execution in there. That's translated at the standard pool level to, again, challenging negative returns for the quarter, as everything there really weren't too many places to hide in the quarter, as you saw earlier. And so we did participate on the downside from an absolute basis. A little bit of underperformance in our income and growth strategy. Again, remember that's about 60% fixed income, 40% in our core strategy, 20% in sterling at long-term targets. A little bit of underperformance for the quarter, but good active performance from our active long-term growth strategy versus its target-weighted index, as well as the passive option. And then the diversification into alternative assets within diversified long-term growth really added value in the quarter as we saw those big drawdowns in public markets. Not only the results or the experience associated with the hedge fund relative to bonds, but also the impact of owning private capital that doesn't price every day helped to hold up those valuations over the course of the quarter. And then over the trailing 1-year period, similar results, similar commentary, with the exception of diversified long-term growth. We talked about this, or I alluded to it earlier. A little bit of underperformance in 1 or 2 components, most notably for diversified long-term growth in that Global Opportunities Fund, and that's caused a hair of specific underperformance versus target-weighted index. Although I'm very happy to see that our diversified structure is adding value versus a more traditional only portfolio, really how it was designed to act. And then good implementation, good outcomes here in our active long-term growth, and similar overall with income and growth. So it's hard to be happy about big downside returns, but we are by and large getting returns that are within expectations of the portfolios that we built and the risk controls that we could hope for in such a dramatic environment that we've just been through. So I think we went through some of these last time, but I wanted to just recap and hit a couple of these a little bit more. So as we're thinking about managing through the current environment, we are maintaining our long-term strategy. We do build these portfolios with the expectation that they're going to go through tough times. And we want to have the kind of, we want to have the kind of diversification that can help protect capital, balanced with the kinds of exposures that can deliver the long-term returns that you need to be able to execute on your philanthropic objectives. And so we are staying close to our long-term strategies. I review often the opportunity to rebalance or make changes. We're still very close overall to targets, and we're not making any big swings or big bets amongst strategy today. And I think July is a good example of how quickly the market can change its mind. So we do want to maintain our long-term strategy. We are actively rebalancing. And then we continue to chat with Greg and the team at FFTC and all of the supporting organizations just around liquidity needs and making sure that we're ahead of those to be able to effectively raise cash when needed. And then we're on the lookout for opportunities. And as parts of the market break, as an example, a historical opportunity for investors has often been distressed debt. If we see parts of the credit markets start to come under increasing pressure, that may be opportunities for a next cycle return potential. So we continue to keep our eyes out for that. So dynamically, I think we talked about this last time, but we went back to target on small mid-cap risk and increased our low volatility. And we are still modestly overweight to emerging markets, albeit as our particularly in DLCG, as our private markets grow, the allocation becomes just a hair less overweight than it was. So Greg, that I think almost, and then I'm sorry, we're retaining our shorter duration underweight bonds. Just as I mentioned, we're expecting more volatility in the fixed income market, and I'm comfortable with our current underweight duration. So with that, that's the end of my prepared remarks, and happy to take questions, and I'll invite Tim to help me out as we go.
Great. Well, thank you, Travis. And as always, we do have a few questions. Since you just last made a comment about duration on the fixed income portfolio, question is, how much of the fixed income portfolio is made up of the low duration piece? And, is there a range around that you typically try to keep that?
We're about, normally I have great command over my statistics, but it's failing me the exact percentages. We're doing 15 and 20% of our fixed income allocation is in depending on portfolio, is 15 to 20% of fixed income allocation is in low duration. It's always a tricky spot in terms of your dynamic positioning. You want to dynamically move because you think there's a risk or a return opportunity, and that's clearly why we have maintained that short duration, because we did think there was a risk from rising rates. At the same time, we have long-term expectations as to what our core fixed income allocation should provide. And so we don't want to get too far. We don't want to make such a massive bet that we lose that longer-term strategic view. So we don't have a defined range per se, but 15 to 20% has been about the maximum that we've been willing to go in most of the portfolios. I'm not sure the environment that would cause me to go greater than that at this stage. That would be a much bigger bet than I think we're willing to make here. We've gotten paid nicely for the allocation at the margin that we've been in, and it's been a nice risk reducer, if you will, which has translated into some marginally better performance for the portfolios.
Okay, good. I know you covered, Fed moves on a slide, but we had two questions come in kind of similar in terms of, what is your expectation around Fed moves? And do you think that the Fed is closer to its neutral rate given recent moves?
So our firm view is pretty close to consensus, and the consensus is really what's priced out on that one page I showed, where short rates getting to somewhere near 3.5 by the end of this year. Based on the Fed's own language, one might argue that they've achieved with this last 75 basis point move their defined neutral rate. The current overnight rate is 2.25 to 2.5. They've stated the 2.5 as their neutral rate. So they've achieved in some ways, they've achieved their neutral rate in the movement that they've taken. However, they've indicated that they'll go past their neutral weight to get inflation under control, and so that I think that telegraphs to some extent additional rate moves through the end of this year. I think 50 basis points, I think, is the consensus expectation for September, and 1 or 2 25s before the end of the year to get us a whole percentage point higher than where we sit today. I've been in some ways impressed with the way that the market has responded to Fed direction, and I think it's given the Fed some flexibility in the way that they apply their interest rate policy. So there are some who argue that the Fed has been slow to raise rates, and that, I suppose, is true in some ways. They've not just jammed on the brakes in terms of raising rates, but because they've telegraphed their views pretty significantly, the market reacted anyway. So we got an actual market reaction that was equal to or greater than the actual rate hikes themselves. And so we've seen this 2+% overnight rate priced into the market long before they got here. And the market's pretty good at being a discounting mechanism. And so I think, and have thought for a while, that it gave the Fed flexibility in what they actually did, because the market had priced in the moves. You already got the financial conditions tightening that the actual raising of the rates might deliver. You got it in the marketplace ahead of time. And I think if we were to see, significant economic rollover through the end of the year, or inflation rolls off the table and it gives the Fed some breathing room to hold up, then financial conditions have already contracted. QT really hasn't gotten launched yet. I mean, the most significant parts of the qualitative tightening and the reduction of balance sheet don't really hit until September. So I think you could see, I don't want to forecast a change in Fed view, but I think that confluence of activities gives them more flexibility to be able to adjust to the data as they see it coming through the fall. One would hope that the Fed doesn't want to see us go into a massive recession to get inflation under control, but inflation is a pretty challenging thing, and they do need to be proactive in trying to get a hold of that. So I think it'll be interesting to watch. Our expectations are, as I stated before, 50 and maybe a couple of 25s, but I do think that this reactive market has given them some room to be able to maneuver.
Okay, thank you. Next question: where are we in the China real estate supply bubble? And how much of the portfolio is exposed to this sector?
I don't know. It's, I guess, as honest as answer I can give. I don't know. I think the news that I see, we haven't talked at length about this internally, but the news that I see certainly isn't great from a real estate bubble perspective in China. They're having some growing pains in that arena, and that could have some consumer economic impacts on them as they roll forward over time. My sense is the Chinese government, especially particularly as they roll into their 5-year Congress here into the fall, they will be as proactive as possible in trying to help mitigate the damage of that. But that is further challenged by their zero COVID policy, which has led to, they've had some more outbreaks. That's led to some challenges and sell-offs, a bit of a reversal here in July and early August. And so that's caused some volatility. So I don't think they're out of the woods yet. We continue to have a long-term constructive view on China. It's the second largest economy in the world. It's forecast to pass the U.S. at some point in some reasonable future. So it's not a place that one can ignore from an investment perspective. We have, I couldn't tell you what our exposure to Chinese real estate is, but we're about market weight, perhaps even a smidge below market weight in China overall, even with our small dedicated China A allocation and the emerging markets piece. It's an important market, so taking a big bet against it has meaningful implications for the overall portfolio in terms of relative performance. So we're not, while there are certainly plenty of things to be concerned about in China as well as other markets around the world, we're basically holding a more neutral stance currently. And we still like that China A market from a long-term performance generation perspective.
Okay. Last question here that's come in so far. Would you speak more specifically to the portfolio's exposure in private markets? Any anticipated insights on what might happen as those markets lag performance reporting in the public markets?
Yeah, and I'll ask him if he has other insights here. He has a lot of, we collectively have a lot of private markets exposure across clients, including with these portfolios. Investors should expect to see markdowns in the second half of the year. Private equity is not immune to big public market drawdowns, and we don't anticipate them to be this time. So I've had some conversations with some of our hybrid managers, so the crossover managers that will do both hedge fund investing as well as private markets investing. Those managers have been quite proactive in writing down their holdings. We just haven't really seen those come through yet in terms of the valuations that we see on behalf of the FFTC portfolio. So I think you're going to see write-downs in the back half of the year. I wouldn't anticipate them matching public market write-downs. We don't typically see that. They're aggressive, not quite that aggressive. And then I think it remains to be seen after that. I think generally speaking, that there's still the general business view of the managers about their businesses is the businesses are still in really pretty good shape. But for those businesses that maybe will look at a funding cliff, all things being equal, there is some expectation to be less capital available as we go through, particularly if we go through a recession. So many of the managers we talk to are working with their portfolio companies to make sure they have the cash and resources needed to get through a trough. And some of those businesses won't make it, and so we'll see some write-downs there, and that will be a natural part of the cycle. But we haven't yet really seen those trickle through. Tim, I don't know if you'd add anything or have any more substance to add there.
Sure. Most of the general partners that I've spoken with, and this was probably going back, a month, so a lot of that July rebound isn't captured. They were expecting write-downs kind of in the order of 10% into kind of low double digits was the expectation. But we saw a meaningful rebound in July, and the investments that they've made recently as prices came down are typically going to be held at cost, so we won't see write-downs on that side. And most of the ones that I've talked to have tried to minimize public market exposure. So to Travis's point, they don't get the full extent of that write-down. But we probably will see write-downs when we see 331 and 630 valuations, but those aren't going to be manifested in the portfolio until sometime closer to the end of Q3 into Q4, given the lag that we see in private markets reporting.
Okay. Well, that concludes the questions that we received. As always, thanks Tim and Travis for taking some time to talk about the markets and, of course, the performance across our portfolios. And thank you to all the participants. Obviously, we hope you find this webinar informational. And should you want to have someone else look at it or look at it again, listen to it again, we will be posting it on our website. So thank you much and have a good rest of your week.
Thanks, everybody.
Thank you.